Hello, everyone. I am Dr. Thamara Barthelus with TU Student Financial Wellness. And before we get started, I would like to go over a few housekeeping items. First, all participants are in listen mode, but please go ahead and feel free to ask your questions as I present. Ask your questions in the Q&A box as I present them. Also, all questions will be responded to or will be answered at the end of the presentation. And finally, the webinar is being recorded and will be available for everyone to view and replay on our website and TU's YouTube channel. Okay. One moment. Okay. Right now, what we will be discussing, now that we have everything out of the way, I will go ahead and share my screen to make sure everyone can see my presentation. Okay, for today's topic, what we will go ahead and do is discuss Credit 101, which will be the fundamentals of credit. So with this topic, we will basically cover just the basics of credit. So if you have never had any exposure to credit, this will be the time where you will be introduced to all the aspects of credit. Okay, so our objective for this lesson is first to define credit. What is credit? And once we've defined what credit is, we'll go ahead and identify what are some of the ways you can apply for credit. And once we've identified that, we will go ahead and finish off with how do you maintain credit once it has been obtained. The first thing I like to do is define credit. A lot of times when we are discussing different concepts, it's always good to make sure everyone is on the same page. So FDIC defines credit as the ability to borrow money. So according to FDIC, which is the Federal Deposit Insurance Commission, credit is basically in their perception is borrowing money, the ability to borrow money. Investopedia, on the other hand, defines credit as a contractual agreement between the borrower where the borrower receives something of value and agrees to pay the lender at a later date with interest. So Investopedia says, you know what, credit is an agreement between two individuals or an individual and an entity where something of value is given and later on payment starts to be given given as a repayment with interest. Now, how do you go about obtaining credit? Credit is obtained in one of three ways. And that is first by visiting the financial institution. It can be a credit union or it can be a bank. So right now with COVID, a lot of financial institutions are providing individuals who would like to obtain credit to apply online or can even apply through a mobile app that is available. So those are some of the ways, three of the ways that you can apply for credit. Now, in order to apply for credit, you would have to go to a financial institution or one of those three methods. As soon as you fill out an application, the first thing that is done is your information is sent to a credit bureau. Once it's sent to one of the three credit bureaus, some financial institutions actually send your information to all three credit bureaus, while other financial institutions only use one credit bureau. And there are many credit bureaus out there, but the three credit bureaus that are considered the national credit bureaus are Equifax, Experian, and TransUnion. Once you fill out your application and the lender uses one of those credit bureaus to access your information, and what the credit bureaus provide lenders is basically your financial history. How well have you maintained credit, and how well have you made payments in the past for credit that was obtained? Now, if you do not have any credit at all, what will happen is nothing will show up when your credit score, I'm sorry, not your credit score, but your social security number is run through one of those three national credit bureaus. So what you're looking at right now is actually one of the scoring systems that the three national credit bureaus use, and that is called your FICO score. And what normally happens is, depending on your credit history, you will be given a score. So the score pretty much lets the credit bureaus know, you know what, this is how this lender or a prospective applicant pretty much fares when it comes to paying back loans, or when it comes to applying for future credit. So if you look here, you will see the range is from 300 to 850. For FICO, anything between 300 and 579 is considered very poor. So normally, if your score is that low, what will happen is, if you apply for credit, you will not receive any credit at all. If you have a score between 670 and 739, chances are you will get quite a few credit applications. And the reason I say credit applications, it should be credit solicitations. What you will notice is, the higher your score increases, the more solicitations that you will get. And what I mean by solicitations are, if you ever go to your mailbox and you see a credit application or credit, whatever it may be, in the mail, it could be an email, it can be something in the mail. If you ever go to your mailbox or your email and you see any of those solicitations, consider your credit score to be increasing. The higher your credit score, the more solicitations you will receive. So if you look here, these are the credit ranges that FICO actually uses. And when a financial institution uses your social security number to access your credit history, those ranges are what they will see. Now, we will skip the questions. Actually, we will go ahead and skip this. Now, let's talk about the FICO scoring models. One of the things that is normally done is, with the FICO and other credit models, is they break it down into your credit score into 5 different components. The first component, and the highest component for FICO, is the payment history. 35% of your score will account for your credit history, your payment history. So if you have a loan, or if you have a credit card that has not been paid on time, 35% of your score will reflect that. The next component is 30%, which is how much of your credit have you used. So if you have a credit score, if you have a credit limit of $1,000 and you use 30% of that, anytime you use 30% of your credit limit, your score will automatically drop. So what the credit scoring models, for example, FICO, does is it looks at your total debt, revolving debt, and determine you have used this percentage of your available credit, and that accounts for 30% of your score. Next, you have length of credit history. Your credit history is 15%. So if you haven't had credit history for a long time, or if you are a beginner, chances are your credit score will not be in the 700s or in the 800s. It will probably start off at a lower score. Then we have 10%, which is new credit. And new credit accounts for how many times have you applied for credit. For example, if you've applied for a credit card in the month of September and then you apply for another credit card for the month, in the month of October or November, chances are it will decrease your credit score. So if you're constantly applying for credit, especially revolving credit such as credit cards, chances are your credit score will be lowered. And finally, 10% is the credit mix. There are different types of credit, which I will go over. The first is the revolving credit, such as your credit card, and second is the installment credit. So those 5 components actually make up the type of credit, or the credit score that you will actually receive. Now, as I mentioned, there are different types of credit, different forms of credit. The first one is revolving credit. Revolving credit is similar to a credit card. And the way that works is you are given a credit limit, and once you use a portion of that credit limit, you pay it back and you go back to that credit limit. For example, if you have $1,000 and you use 200 of that, that means you have $800 left. But if you make a payment of $200, then your limit goes back to $1,000. So the way revolving credit works is you use some, you pay it back, and it goes back to the original amount. So it's constantly revolving. Installment loans, on the other hand, installment credit, on the other hand, are similar to loans. The way loans work are if you have a, let's say, for example, a car loan, once you make payments and you pay it off, then that loan is closed. So that credit automatically, after a while, usually after 7 years of having paid your loan, it will automatically fall off your credit history. And the final one, I'm sorry, I'm not sure what's going on with the slides. Okay, the final credit is open service credit. Now, this type of credit you don't normally see on your credit report unless you default on your credit. And an example of that would be your service to AT&T, or if you have PSO, if you have your water bill, you will not see those on your credit report unless you, for whatever reason, you're unable to pay. Then after a while, maybe 90 days or 120 days, what will happen is they send it to collections, and from collections, it will probably appear on your credit report. So with that, it does not appear on your credit report at all. So a lot of people do not consider it to be a form of credit, but in reality, if you miss a payment or you miss several payments, then chances are you will see it on your credit report. Now, credit is categorized into 2 categories: secured credit and unsecured credit. Secured credit is when you have to provide collateral. For example, a car. If you go to a bank and ask for a loan to purchase a car, what you would do is obtain the car from the dealership, and then the bank would actually have collateral, you will actually back that up with your vehicle. So if for whatever reason you're unable to pay for your car, what will happen is, since the bank funded the loan for your car, then the bank will actually come and repossess your vehicle. So secured loan is something that is backed by something. So as a car, for a car loan, it will be a car. For a mortgage, it will be the home. So that is considered a secured loan. Unsecured loan, on the other hand, is usually provided to individuals with high credit scores. And those are usually provided in the form of a credit line or even credit cards. So it's usually backed by the individual's credit worthiness. So that individual would have had to have some form of credit history in order for him or her to be able to have an unsecured loan. Now, one of the things that is necessary to remember about credit is this: whenever credit is extended to you or extended to me, you have to receive a disclosure, a truth in lending disclosure. And that could be a credit card, it could be a personal loan, it could be a mortgage loan, whatever it may be. Whenever you receive funds from a bank or any form of financial institution, by law, you have to receive a disclosure. And the disclosure pretty much outlines the agreement of your borrowing. So there are 4 different things that are covered. The first is how many payments will be made. Second is what are the finance charges? And finally, borrowing, what is the amount that has been borrowed, and also the annual percentage rate that you will be paying. By law, if you ever receive or credit extended to you and you don't get that, if you don't receive that from a lender, make sure you ask for that. Okay, the second part is applying for credit. Now, whenever you're applying for credit, some of the questions that are normally asked, especially of individuals who have not had credit in the past, is, do I qualify? How will I be able to qualify? And what do I need to apply for a loan? One of the things that I would like for everyone to remember is through annualcreditreport.com, you can actually receive a free credit report, okay? Now, normally people say that you can only receive 1 credit report through annualcreditreport.com, but the truth is you can actually receive 3. Remember, there are 3 credit reporting agencies, national reporting agencies. If you apply to them for your credit report at different times, let's say for the month of September, you apply, you access your credit through TransUnion, and then 3 months later, in December, you access your credit through Equifax. Then that's 2, and then a few months later, you access another credit report for you to be able to get your 3rd one. So always remember that the way you spread it out will determine how many you're able to get. So if you go to all 3 credit bureaus at the same time, chances are you'll only be able to receive 1. But if you spread it out and you get 1 through each credit bureau, then you'll be able to access your credit report 3 different times throughout the year. And again, you can access it online, via phone, or if you choose to use snail mail, you can also do that as well by mailing a request for that to happen. Okay, now one of the things that must be kept in mind is whenever you are or I am applying for a loan, there are 5 things that lenders take into consideration, because whenever loan or money is being extended to us, the lender is actually taking a risk, okay? The first thing is our character. How have we paid our bills? Have we paid our bills on time? Second is what the lenders call capacity. What is our current debt load? Third, what is our present and future ability to pay our debt? Okay, and that is actually considered capital. So if we don't have a job, then chances are our lender will not consider us as someone they can extend credit to. And fourth is collateral. Collateral, pretty much we've described earlier, is how can you back your loan, especially if it's a high dollar amount loan, and you're wanting it to be a personal loan. Business loan, of course, it will be backed by business, but your personal loan, usually if it's over $1,000, a lender will say, do you have any collateral? Okay, and condition is something that is fairly new. Lenders started adding that to their list. Initially, there were 4 C's to lending, but they added the 5th one because of the way the economy is going right now. So condition pretty much includes how you will use the money as well as the economic conditions. So if you think about our economy right now, or even what is taking place with COVID-19, those are some factors that lenders take into consideration, because let's say, for example, I would like to take out a personal loan of $2,000 so I can start a nail salon. The lender will take into consideration the fact that COVID-19 is taking place, which is causing individuals to not be in close proximity. So if I'm wanting to start a nail salon, the lender may think, you know what, my nail salon will not flourish. Therefore, my ability to repay the loan back will be slim or none at all. Okay, so the economic conditions are taken into consideration. And another thing, now what I'm doing is breaking down each of the C's, the 5 C's. The first one is the capacity, which is debt to income ratio. What they'll look at is how much money are you bringing in, and how much debt do you currently have? So when you apply for a loan, whenever you're asking for credit, the lender will ask you to put your income down. Once you write your income, the lender will ask how much debt do you have? Now, the thing about it is this: on your credit report, the lender will not see that you have that you are paying rent and that you have PSO, you have utilities to pay. So those are things that you have to take into consideration when applying for debt. But they will see if you have a mortgage. Whatever is listed on your credit report is usually what the lender will take into consideration. Now, some lenders will ask other information. For example, how much do you pay in rent? So all of those factors are taken in. Now, what they normally do is they look at the percentage of debt that you have, and they'll determine, based on your debt to income ratio, whether or not they will lend or how much they will lend. And usually if you're at 30%, chances are they'll think this individual will be unable to pay the debt, because me giving debt to, and I'm speaking as a financial institution, if I'm a financial institution, I extend more debt to you. Now, of course, it really depends on why the debt is being, not the debt, but the loan is being asked for. So if I extend more debt as a financial institution, then this individual will be in a worse situation. And me as a bank will look at it as there's no way this individual will be able to make the payments. So capacity is a big thing. Collateral, we already talked about collateral. Now, one thing I will say is this. Let's say, for example, I take out a mortgage loan, and the mortgage, for some reason, I lose my job and I am unable to make mortgage payments. Even though the bank will have the home as collateral, what normally happens is the bank will have to sell that item. Banks are not or credit unions are not in the habit or in the business of collecting items that individuals have used for collateral. So they will sell it and get as much profit as they can out of it. But just remember that if you're borrowing, or if I'm borrowing money, then we have to keep in mind that there are certain things that we have to prepare for, just in case, especially in this economy. So when banks are asking for collateral, a lot of times, of course, we can't predict what will happen in the future, but collateral is something that banks will ask for. And once we provide it, if it's enough collateral, then they'll of course go ahead and get it. But there are other times where the bank will say, even though you have this collateral, it doesn't have much value. And they may try to actually come back and get more funds, depending on how much you borrowed. Capital is essentially how much are we worth? So banks will look at how much money do you have in your checking account, how much you have in your retirement account. And if you have insurance, if I have insurance, it would be the cash value of the insurance. So it's not how much money that will be paid out upon your death or upon my death, but it's what is the cash value if you needed to borrow, if I needed to borrow from my insurance, is that an option? And finally, we pretty much talked about the conditions, economic factors that affect whether or not a bank will be able to lend. So, and always remember as well, I remember in 2008 when the economy was really going bad and there were so many banks losing there were many banks who were being closed because they lent a lot of funds to individuals, but those individuals were unable to repay those funds. So a lot of times banks struggle when their community struggle as well. So if we borrow, banks pretty much lend money based on the number of deposits or the amount of deposits that they receive. So if individuals are losing their jobs and they're unable to make deposits, then banks are unable to lend money because with deposits, they're able to lend money and they make money off of the interest. So when situations like COVID hit and businesses are closing, individuals are losing their jobs, those are factors that banks take into consideration when deciding whether or not to lend. I read an article earlier today where it said, even for personal loans, usually business loans, banks are very strict on providing funds, but for personal loans now, banks are becoming a lot more tight-fisted on whether or not they can provide funds simply because the economy is so iffy. One minute individuals have jobs and the next minute they don't. So banks are looking into so many factors, and that is why the economic factors are a major role in whether or not banks lend money to individuals. Now, when you're wanting to apply for a loan, there are 5 things to keep in mind. The first one is review your credit report. And the reason why I say that is, okay, my computer has a mind of its own. The reason why I say that is for those who do not have credit at all, a lot of times you may think, okay, I'm safe. I don't have any credit at all. So I will go ahead and just apply, and this will be my first experience with credit. I recommend every individual actually review their credit every 6 months or every 9 months. Review it at least twice a year. And the reason why I say that is there was an individual several years ago, and this was on the news, who she graduated from high school. When she graduated from high school, having never taken out any loans at all, she applied for student loans, but kept being denied for the student loans. And she couldn't understand why, her parents couldn't understand why. So she decided to inquire. Whenever you apply or I apply for a loan and we have been denied the loan, I'm sorry, my computer is going a little ballistic here. But whenever we apply for a loan and we have been declined, the financial institution has to provide a reason why. In this instance, the individual found out that there was someone else using her social security number, and that individual has created an identity using her information. So that individual purchased a home, purchased a vehicle, and pretty much lived from her social security. So I even tell parents, make sure you pull a copy of your child's credit report, even though there shouldn't be anything existing. But just run your child's credit report through the national credit bureaus to make sure that everything is okay. The youngest victim whose whose social security number has been used was 5 months old. So in order for us to be where we need to be, we need to make sure we do our own due diligence and keep up with our credit, keep up with our finances in more than one way. Okay, so always review your credit report. If you already have credit established, I recommend reviewing your credit report just to make sure everything is accurate. If there is an error on your credit report, make sure it is removed. Contact the credit bureaus. And the next lesson I will teach, actually next week, is credit report, understanding your credit report. So, but I'm adding this just in case anyone plans to apply for a loan. But if there's any information on your credit report, excuse me, that shouldn't be there, make sure that information is removed, not only from one credit bureau, but all 3 credit bureaus, okay? So once that is out of the way and you're okay with with the information on your credit report, go ahead and determine the amount that you're needing. Find out how much do you need, and from there, go to the bank and identify which loan type is best for you. There are different types of loans, okay? Is it a personal loan? Does the loan have to be collateralized? So make sure you go to the bank, or you can even do your research online. The next step is actually compare offers. Credit Karma provide a good tool for individuals who have accounts with them. One of the things that you can do is, if you're looking for a loan, you can actually go to Credit Karma, enter your information in, and it will provide you with a list of financial institutions from the list from their partner list, and let you know which of those banks can provide you with the better offer. So if Credit Karma is something that you use, and it's very reputable, if it's something that you use, that is an option for individuals. That way you don't have to go to bank 1, bank 2, bank 3 and ask them, what is your interest rate and what types of loans do you have? You can do one-stop shop with Credit Karma. And finally, once you have identified what type of loan that you're needing, find out what is the documentation that you need in order for you to obtain the loan. And how do you maintain credit? Maintaining credit is not hard. A lot of people may think that it is hard, but it really isn't. The first thing that we have to be able to do is pay our bills on time, okay? Borrow only what we can repay. And I think a lot of us get into trouble. I know I did when I was in college. My first credit card was $600, and my first purchase was a Looney Tune jacket for $300. Yes, crazy. But that was my first purchase. Of course, we did not have a financial wellness office, so I knew nothing about credit. So when that happened, I ended up not being able to, when I graduated, of course, I eventually paid the bill off. But by that time, my account was already closed. And with my account being closed, it was reported to the credit bureaus. And when I graduated, I found it very difficult to actually get a job, because a lot of employers look at our credit when it's time to apply for a job. The third point is review all terms of credit. And as I mentioned earlier, one of the things that is required of lenders is to give us a disclosure. But if you're like me, back in the day, what I never did was read the terms of my credit. I was happy I got the money, and everything else that came in the envelope or that came with the package was put to the side. But make sure you read the terms of the agreement. What happens if you pay late? What is the grace period? What is the interest rate that must be paid? Will the interest rate increase if there's a late payment? Because for credit cards, for some credit cards, if you default and you are more than 90 days late, then your interest rate pretty much doubles. And it doesn't matter if you had a great credit history, credit score in the beginning. If you're more than 90 days or more late, your credit score pretty much doubles. So it's important to know all of those facts. And also review your credit report annually. And I would say review it more than once annually, especially with our economic conditions right now. People are desperate, and for some people, dishonesty is one of the things that is an option for them. So if you're easy access, then they will do whatever it is to use your information to make sure they actually get what they need. So let's make it hard for individuals to use our identity. Because the dark web is available and people are buying social security numbers to be able to use other people's identity. So check your credit report annually at the very least, but I would say 3, maybe 4 times every year. And also borrow to increase assets. And that is another lesson that I will actually teach. What I mean by that is whenever you borrow and you're borrowing to actually make your life better. And what I mean by that is you're actually buying a vehicle. If you have a vehicle, then you can maneuver, you can have a job, and you'll be able to keep the job because you don't have to worry about city transportation. And also if you purchase a home, individuals who purchase homes tend to take better care of it. So whenever you're borrowing to increase assets, those loans are considered good debt. There is such a thing as good debt and bad debt, and increasing assets, loans that are backed by collateral, car, home, and believe it or not, student loans are considered good debt. Okay. Also shop for the best interest rates. If you just take out or receive or accept whatever the first loan that is given to you or the first credit card that is given to you, and it has a very, very high interest rate, chances are you will never be able to pay it off because all of the payments that are being made will be applied towards interest only. Okay, so you want to be able to borrow and also borrow responsibly. When you do that and you know the interest rate and you keep it as low as possible, then you'll be able to pay off the loan. The bottom line is to borrow what you need, be able to pay it off, and be debt free. Okay, and finally, and this part is very, very important. If for whatever reason you fall into financial challenges, you're unable to make any payment, normally what people do is they hide from the creditors, or they do not, they just shut down completely, because it is a hard reality when you're unable to make your payments. So for a lot of individuals, what they tend to do is they do not answer calls from creditors because they will call, okay, and call quite often. So they do not respond to those calls. So what creditors eventually do is they send them off to collections, and collections will try to call and then collect funds for them. And eventually, if nothing really happens, then it's reported on your credit bureau. One of the things that I have worked for a financial institution for almost 23 years, and believe it or not, financial institutions are willing to work with us. So whenever hard times come and we're honest with them and we tell them exactly what it is that we can do in terms of repayment, they are willing to work with us, because if you think about it, they want to work with us because they want their money back as well. Okay, so try not, if you ever run into financial difficulties, make sure that you contact them first. Okay, before they come to you, contact them first, because they may have a program that may assist you. Okay, for example, for car loans, if you have a car loan and you're unable to make your car payment for that month, banks, credit unions usually provide individuals with an opportunity to miss one payment. But if you don't contact them, you would never know that, okay? And now that we've reviewed quite a bit, let's summarize what we've done, what we've learned today. First, we defined credit. Second, we identified the different methods of applying for credit. Then we reviewed the national credit bureaus. We talked about the 3 national credit bureaus that are out there, as well as the scoring models. Even though we only reviewed one of the scoring models, there are several. But the scoring model that is commonly used, which is what I discussed, is the FICO score, because that is used by 90% of our lenders. Oops, my computer is going crazy. Okay, then we discussed the 5 C's of lending, and that is what lenders take into consideration before loans are extended to us. And also the 5 steps of applying for credit. And finally, identifying 7 steps to credit management. Okay. I really appreciate everyone who actually joined me. And one thing I would like to say is our next money move will be next Thursday, September 17th. And in that lesson, I will be addressing understanding credit reports. I kind of touched on it a little bit today, but I would like to delve into it a little more next week. That way we have a full understanding of how credit reports work and how it affects us, okay? And finally, don't forget to complete our survey, letting us know how we've done and what you've learned and what can we add and what else you would like to see, okay? Okay, now I will go to our Q&A. I will stop sharing right now and see if there are any questions. Okay, I do not see any questions at the moment. So if there are no questions, thank you for joining. I will, hold on one moment. Okay, I do not see any questions, but I would like to thank you for joining, and hopefully I will see you next week when we discuss understanding credit reports.